and stronger. Whenever you have issues relating to assignments, you can do well to private chat me, and I'll respond once I'm free. Yes. I sent a question this morning, yes, platform. So as part of my comment, that I will explain how to solve that question, the steps required. Then I will expect everybody in this class to follow that steps and solve that question. Yes, I'm adopting that approach because one thing with ICANN is it's what you know that you go and put down in that exam hall. It's not what your tutor knows. Your tutor will guide you, but it's good you pen it down yourself. Yes, you pen it down yourself. Some people don't like writing, so once they go to the hall, to write becomes difficult. Yes, and they'll say ICANN is this, is that. Yes, so learn to solve assignments, learn to practice, and that is how you get. Please, if your background is noisy, just mute yourself, please. If your background is noisy, just mute yourself. Yes. All right. So pick it up from where we stopped today. I hope to finish all I have to discuss today. I don't want to have any carry forward. Yes. So we'll be talking about capital structure, the theory of capital structure. We're looking at the traditional approach, and also be looking at Miller and Modigliani, the M&M preposition with tax and without tax. We're showing you what they entails. Then we move on to the issue of specific cost of capital. So yes, based on my slide, that's note the following, that there are two reasons why the costs of additional finance raised is likely to be different from the current cost of capital. Yes, an organization can be in existence and their capital structure can consist of only equity. Their capital structure can consist of only debt. Their capital structure can be a proportion, a composition of debt and equity. Yes, it can be in form of debt and equity, but let's say in the ratio of 2:1. There are instances where additional capital can change the ratio, can change the proportion. There are instances where the additional capital finance can make the proportion to remain same. If you are getting additional 2% of debt and additional 2% of equity, it means the capital structure will still remain at same proportion. So that changes in the level of gearing. If, for example, the new finance is to be raised entirely from equity, then two things will happen. That is, firstly, the level of gearing in the company will change. And this clearly will affect the weightings when we come to calculate WACC. We talked about WACC in our last class, that is the weighted average cost of capital. So, secondly, Changes or higher gearing will increase the level of risk. When we talk about gearing, we're talking about leverage. We're talking about the depth in an organization, how a company is using debt to finance their business. So that higher gearing will increase the level of risk for the shareholders, and therefore shareholders are likely to require a higher rate of return, which will in turn increase the cost of equity. We're going to see more of this as we proceed. So the WACC is likely to change as a result of the way in which the new finance is raised. So if you have more equity beyond what is in existence before, your WACC will change. If you have more debts, more than what you have before, it will affect your WACC, your overall WACC. So you're going to see more of this. Now, changes in the level of business risk. Changes in the level of business risk. One factor that will influence the current cost of equity is the level of risk of the business. And there is one thing that will bring about business risk. Business risk most times is peculiar to a particular kind of business, that's irrespective of your location, irrespective of where you exist. Once you are into a kind of business, you are likely to face such risk. Yes. So shareholders of a company engage in risky type of business and require a higher return. So if more finance is to be raised in order to invest in a new project, then the riskiness of the project will affect the shareholders' required rate of return. So the more risky the project, the higher return they are likely to demand. So as a result, the WACC is again likely to change depending as to how risky the new project is. So the new project can be in another business line, separate from what they have been doing. So business risk will surface. So the point is when to use the existing WACC for investment appraisal. In a question, I can tell you that the capital structure have changed. It means that the current WACC in the question will not be viable again. So it is only reasonable to use the current WACC when we are sure that the cost of the new finance will be same as the current WACC. So we can only be sure of this if two conditions applied. That is, the level of gearing in the company will remain unchanged. So in a question, they can tell you that a company will no longer adopt or go along with their existing capital structure. It shows that the WACC will change. So if the new project is financed partly with equity and debt in such a way as to keep the level of gearing unchanged, it means that in this case, the WACC will remain same. So, and also, when are we to use the existing WACC? When the new investment carries same level of risk as the existing activities of the company. So if both of these factors apply, then it is reasonable to assume that the WACC of the company will remain unchanged, and therefore the cost of the additional finance will be equal to the existing WACC. So please, when solving questions, allow the question to lead you. Yes. Don't go ahead of the question. Don't say, I've known it. Yes, no. Allow the question to lead you. Sometimes the question might still want to maintain the existing WACC. Sometimes the question might tell you that the capital structure have changed. So in that case, you need to go ahead to compute for that. So we can therefore appraise a project using existing WACC if the new investment carries the same level of risk as the existing activities of the company. What if the conditions for using the current WACC do not exist? What if the conditions for using the current WACC do not exist? So if either the level of gearing changes or the level of risk changes, then
No. I said no. No. It's based.
it's always going to mute yourself. So if either the level of gearing changes or the level of business risk changes, then it is not valid to use the current WACC. It is not valid to use the current WACC. If debt change, if equity changes, it means the current WACC will not be viable. So we need to know the costs of additional finance for the project, and therefore need to be able to measure the effects of changes in gearing and changes in business risk. So I put in green that do make sure you master the concept of cost of capital. Yes, there is no how you escape this in the forthcoming exams. Yes, it can be linked to any question. Yes, that is one thing with the issue of cost of capital. It can be tied to any question, and you can even see it in more than one question. So by the time you don't have a good grasp of this, um, the story will not be palatable. So do make sure you master the concept of cost of capital in an examination. If you are not given information about how a project is financed and about the business risks of the project, then you assume both remain unchanged and you discount at the current WACC. If, on the other hand, one or both of the factors do change, then you will need the theory of gearing. You need the theory of gearing. So now this word gearing, I won't be surprised if somebody will ask me, what is gearing? But before you ask me, let me ask the class, what is gearing? Because somebody can just ask me now, gearing. So you should have known that you've been doing SFM for some months now. Yes. But let me hear. Stephen, can you speak? Yeah, somebody should tell me what gearing is all about.
I'm not 100% sure, but I'll see gearing as a combination of both the
Yes, I'm with
the
you.
Hello, sir.
risk of the business. Let me check
Gearing
now.
talks about the the proportion of capital that belongs to those who are not the owner of the business. Borrowed capital.
Okay. All right. Thank you very much. All right. Thank you. Yes. When you are in a class, you don't, a teacher or a lecturer should not assume. So that is why the question might look so childish, but it's very important I asked. So gearing refers to the level of a company's debt compared to its equity. So it shows how much a business relies on borrowed money, that is debt, to finance operations and growth. So we need to avoid some confusion, which is possible when using the word gearing. Yes. Firstly, we should make a distinction between operating gearing and financial gearing. When we talk about operating gearing, this refers to the extent to which the firm's total costs are fixed. Total cost now. Mr. Olalikon, can you speak?
It's fine, sir. You can go ahead, sir. It's fine.
All right. So operating gearing said this refers to the extent to which the firm's total costs are fixed. That is, the profit of firms with a high operating gearing. There are some organizations with high operating gearing, such as a car or steel manufacturers, because they are very sensitive to changes in the sales level. So they have high break-even points. But when this level is breached, a large portion of any additional sales revenue turns into profit because of the relatively low variable cost. So we have operating gearing and we have financial gearing. The financial gearing is our major concern in this class, that this is the focus of strategic financial management. And what does this entails? It is concerned about the proportion of debt in capital structure. So the term gearing and leverage are used interchangeably. Take note of that. The term gearing and leverage are used interchangeably. So for you to compute gearing, if you've done ratio analysis over time, you will know that there are different ways you can calculate capital gearing in terms of ratio. Yes, Mr. Lucky.
Sorry, sir. Before you go far, I just wanted to help me to rephrase that operating area. I did not really get it 100%.
Okay. All right. The operating gearing, it measures how sensitive a company's operating profit is to change in sales. So it depends on the mix between fixed cost and variable cost. So when we're talking about operating, from the word operation, what are those elements or those factors that you use in your organization to operate? And those costs include fixed costs, variable costs. The fixed costs, you know them. Shouldn't be giving examples here of such. Though we have machineries, the variable costs, we have things like raw materials, commissions. There are costs that varies with the production level. So the operating cost, I said, it refers to the extent to which the firm's total costs are fixed, and that the profit of firms with high operating gearing are often sensitive to changes in relation to sales level. So operating gearing measures how sensitive a company's operating profit is to a change in sales. And what are these components that make up the operating gearing? Is the fixed cost and the variable cost. But I said that is not the subject matter of this class. The main subject matter of this class has to do with financial gearing. But for knowledge purpose, it's good you know that. So you know that we have issues of operating gearing and financial gearing. Hope that is fine. So we have forms of gearing. Now, the issue of gearing that is what you should have concerned with when you're computing ratio, because when you want to calculate capital gearing is a makeup of long-term debt divided by shareholders' fund. Another word for shareholders' fund is equity. And if you recall, those times we were calculating ratios, sometimes you discover in a question that we use shareholders' fund. Sometimes you see long-term debt plus shareholders' fund. So there are various ways, depending on the question, you can calculate capital gearing in terms of ratios. It can be computed as long-term debt divided by shareholders' fund. Another word for shareholders' fund is equity. It can be computed as long-term debt divided by long-term debt plus shareholders' fund. Yes. And more so, it can be computed as all borrowing divided by all borrowing plus shareholders' fund. That is capital gearing in form of ratios. In form of ratios. If you are used to ratio, if you are still here to write case study, you should know some of all these things. So if you've written case study, you should reflect back on some of these things, and they'll be very useful. Now, the effect of changes in gearing on cost of capital. The effect of changes in gearing on cost of capital. Now, we have various approach in relation to capital structure, that there are two main theories about the effect of changes in gearing on the weighted average cost of capital. There are two main theories. Take notes. We have the traditional theory and we have the Modigliani-Miller. Now, what is the traditional view of WACC? What is the traditional view of WACC? The traditional view suggests that WACC initially decreases with increased gearing. That WACC initially what? Decreases with increased gearing. If you look at this graph here, you can see as debt is introduced, you can see WACC begins to fall. As debt is introduced, WACC begins to fall. So, however, beyond a certain level of gearing, the WACC starts to rise due to increased financial risk. You can see at this point, the WACC picks up because the more debt introduced, the more the equity holders demand for returns. So WACC starts to rise due to increased financial risk and the high cost of equity. So as equity holders demand a higher return for the increased risk, because with the introduction of debt, the equity holders are subjected to more risk. So the more, with the introduction of debt, the WACC begins to fall. As the WACC falls, it gets to a point, it picks up again. So you can see that on this graph. So an organization that introduced debt into its capital structure, the WACC will fall because at the initial stage, the benefits of cheaper debt will outweigh any increase in the cost of capital or any increase in cost of equity. So this will occur to compensate what? The equity holders for higher financial risk they are being put into. So the traditional view shows that with the introduction of debt, the WACC decline, get to a point, it rise again. So that is the concept of the traditional view. So as gearing continues to increase, the equity holders will ask for increased return. We ask for higher return. Yes. So I don't want to dwell too much on this. Yes. Now we have the issue of Modigliani and Miller proposition. There are two cases of this. We have a case where there is where they ignore tax, and there is a case where tax is introduced. So talking about Modigliani and Miller theory, that in 1958, two American economists, that is Professor Frank Modigliani and Menton Miller, they challenged the traditional view of capital structure by justifying the net operating income approach. So the Miller and Modigliani view is that companies which operate in the same type of business and which have similar operating risk must have same total value. That is their view, that if we are operating in the agricultural sector, we should be exposed to same type of risk. We should be exposed to same type of risk, irrespective of our capital structure. That is in the absence of taxation. In the absence of taxation. So their view is based on the belief that the value of a company depends upon the future income that will be generated by its assets. So Modigliani and Miller, they sought to explain the real-world influences on gearing. Their objective was to build models that would aid financial managers in making decisions about gearing levels. So their starting point was to construct a model based on a series of simplifying assumptions to see what would be expected in this simple world. So their assumptions include that there will exist a perfect market. A perfect market. And what are the features of a perfect market? What are the features of a perfect market? Can I get response? Features of a perfect market.
Free entry and free exit.
Okay. Free entry and free exit, yes.
Homogeneity.
Homogeneity, yes.
There's a buyer, there is a seller.
Okay, there's a buyer, there's a seller. All
Willing
right.
buyer.
No
And I
transaction
think,
cost.
all right, and there is free flow of information, right?
Yeah, different information.
Yes, there is nobody is taking advantage of privileged information. So what you know, I know. Yes. So as part of their assumptions that there will be the capital markets are perfect, that all investors value security in the same way, and there are no dealing costs. Another word for dealing costs is issuing cost, and there's perfect information. All participants know and understand any new information that is in existence. And more so, part of the assumption is that there is no taxation. There is no taxation. There is nothing like tax shield. But as we go ahead, we'll see the introduction of corporation tax in the next instance. So, and also that there is no bankruptcy risk, and investors are identified between borrowing themselves or investing in companies. Please, some of these things might look so as if they are simple. They can easily test them in a scenario questions. So please do well to know them. Do well to know them and have them at your fingertip so that when they come, I've seen it before, but I can't remember. So that's all those kind of speech are not good. So you've seen it before and you should know it. So that should be the watchword. Yes. Still on this, on Miller and Modigliani case without tax, I said that remember that they did not say the word was like this, that the nature of mathematical modeling is such that the model is constructed to describe a simplified version of what is being studied. So predictions on the model can then be compared with the real world in any attempt to understand the impact of real world influences. That often people write that their model was incorrect and was open to criticism. But the more accurate statement is that the model does not accurately describe the real world. Yes. And however, did not expect it to actually describe the real world. So if you look at this graph, you can see that at this point, when we have equity here, the equity is increasing. Even with the introduction of debt, the WACC remains constant. The WACC remains what? Constant. It shows that irrespective of the capital structure, the value of ungeared and the value of geared in terms of WACC will remain same. You'll see the equation very soon, that the first proposition of Miller and Modigliani is that the value of geared is equal to the value of ungeared, where there is no tax. And also, the cost of equity geared is equal to cost of equity ungeared plus debt divided by equity. So we're going to see that equation soon. But from this graph, you see that even as equity changes, as the capital structure changes, the WACC remains constant. So without tax, the value of a firm, either geared or ungeared, is same. That is Miller and Modigliani proposition without tax. So Modigliani and Miller's argument ignoring taxation can be summarized as two propositions. That is, market value of geared is equal to what? Market value of ungeared. The propositions are that the WACC is constant at all levels of gearing. For companies with identical annual profits and identical business risk characteristics, their total market value, equity plus debt, will be the same, regardless of differences in gearing between the companies. And the proposition 2, the cost of equity rises as the gearing increases. The cost of equity rises, you can see it's increasing. As debts increase, the cost is increasing likewise. So the cost of equity rises as the gearing increases. So the cost of equity will rise to a level such that, given no change in the cost of debt, so the WACC remains unchanged. That is Miller and Modigliani without taxation. So now, this is the formula in relation to the preposition. That preposition 1, the WACC in a geared company and the WACC in an identical company but ungeared are same. You can see it. WACC of geared is equal to WACC of ungeared. And in terms of the market value of geared is equal to market value of ungeared. Now, in terms of cost of equity, the cost of equity in a geared company is higher than the cost of equity in an ungeared company. Now, looking at this expression, that cost of equity geared is equal to what? Cost of equity ungeared plus what? plus market value of debt divided by what? Market value of what? Equity multiplied by cost of equity ungeared minus cost of debt. This is Miller and Modigliani without taxation. Without taxation. So that as gearing increases, the WACC remains constant. The WACC remains constant. So this is Miller and Modigliani without taxation. Without taxation. Now, the whole variables, you know, don't need to start defining them. Now, let's look at this example. Let's look at this example. Yes, can somebody read?
Okay, let me read. Example M&M, no tax. An all equity company has a market value of 1 million and a cost of equity of 10%. It borrows 50 million of debt finance costing 6% and uses this to buy back and cancel 50 million of equity. Tax relief on debt interest is ignored. Required, according to Modigliani and Miller, if taxation is ignored, what will be the effect of the higher gearing on A, the WACC, B, the total market value of the company, and C, the cost of equity in the company?
All right, thank you very much. Now, looking at this question, that's an all equity. An all equity means what? Yes, yes.
Ungeared.
I'm a gear company.
Very good. Ungeared company. Yes. So please follow. You solve it. You solve it. Yes. I'll just guide you, then you solve. Yes. So an all equity company has a market value of 150 million. Yes. And a cost of equity of what? 10%. It borrows 50 million of debt finance, costing 6%, and uses this to buy back. Take note of that word. To buy back and cancel what? 50 million of equity. It means the organization is having 150 million in terms of equity. It borrows. It means it has engaged in debt. The value the organization borrows, they use it to do what? To buy back equity and cancel that value of equity of 50 in the proportion of 50 million. So that tax relief on debt interest is ignored. So now the question is, according to Modigliani and Miller, if taxation is ignored, what will be the effect of the higher gearing? Now, what will be the effect of the higher gearing on the WACC? If taxation is ignored, what will be the effect? What will be WACC now, where there is no taxation? The existing WACC is what?
10%.
10%.
The WACC is 10%. Take note of the rule of Modigliani when there is no taxation. Now, even when we have a change in capital structure, will the WACC change? Even
No,
when
sir.
we have is no. So the response now would be, what will be the WACC? The WACC in the company,
WACC remains constant.
it remains constant, unchanged at 10%. Take note of that. Somebody will say, but they introduced 6%. So in Miller and Modigliani, the value of geared is the same thing as what? Ungeared. So the WACC remains constant at 10%, because we are just doing what? Reducing equity and increasing our debt by 50. Equity is reduced to 100, while debt is increased to 50. So we still, the capital component structure is 100 to 50. Before, it was just all equity of 150, but now we've introduced debt to it. So it is now a geared company likewise. So now the total market value of the company will be what? The market value of the company will be what?
150 million.
Yes, it will still be 150. 100 of equity plus what? 50 debt. That will be the total market value of the company. So the cost of equity in the company will now be what? The cost of equity in the company will be what?
Still 10%.
Not 10%, sir. The cost.
We have to use the formula, proposition 3.
Please see the formula here now.
I'm not seeing anything.
Your screen is no longer showing.
It's your
Screen is
network.
showing now.
Check your network. The screen is
It
showing.
is your network. You can see the screen.
So the cost of equity will be what? Using this formula now. Using this formula. From the question, cost of equity is what? It's 10%. 10%. Write it down. I will not solve it. Cost of debt is what?
6%.
6%. Good.
We have 12%.
Okay, yeah, 12% the overall. But let's for others, for the sake of others. So the cost of equity is 10%. The cost of debt is what? 6%. Now, the market value of debt is what? The market value of debt is what?
6%.
50 million. The market value of equity is what?
100.
100
million.
Good. So the cost of equity on GED is still what?
10%.
Minus the cost of debt is what?
6%.
6%. So please substitute those values into this formula and give me the answer. Though somebody have said 12%, but let's confirm.
Yes, sir, it's 12%.
Yes. Everybody must get it. If you are not getting it, means
It's
something is happening.
12%, sir. 12%, sir.
All right, fine.
It's 12%.
Okay, 3%. You need to check that workings again.
12%.
All right, it's fine. It's fine. Just check it again. So this is it. This is it. So I don't want to waste much time, because if I should waste time, I will not conclude tonight, and I want to conclude tonight.
Please, don't be offended. I did not get the formula, sir. Network has been yanking me off. I wasn't seeing your screen since. Please. I want to get the formula, please, sir.
So this is the formula. But I might not want to be staying long or bringing me back. You can always have access to the video, or I'll send the slide to you. If not, somebody else will come up with another excuse again, and I'll keep lagging behind. So Hope you are fine now, man. All right. So let's move on. Modigliani and Miller view allowing for corporation tax. So M&M model without tax leads to the conclusion that gearing is irrelevant, because if my market value when I'm geared and when I'm not geared, it's same thing. Please, when you are talking on the ground, you are distracting me. Madam Chuma. So the M&M model with taxation, that the key idea with this is that debt provides tax shield. Debt provide tax shield. That is, when corporate income tax are introduced, interest on debt becomes tax deductible. So this gives debt a tax advantage, leading to an increase in firm value. So in 1963, M&M model, or Miller and Modigliani, amended their model to include corporation tax. And this amendment or alteration changes the implication of the analysis significantly, because with corporation tax system, where returns to debt holders are deductible to the firm, Miller and Modigliani concluded that geared companies have an advantage over ungeared companies. That is, they pay less tax and will therefore have greater market value and a lower WACC. So the value of a leverage firm, of a geared firm, is higher than an unleveraged firm by the present value of tax savings due to interest. So M&M model without tax, I said, it leads to the conclusion that gearing is irrelevant. That, however, this is clearly not true in the real world, as many companies are geared. So this leads to the question of what is there in the real world which would cause the model to behave differently. So one possibility is the existence of corporate tax. So the existence of tax relief on interest reduces the cost of debt, and this puts an additional downward pressure on WACC. So Miller and Modigliani revised their model to include corporation tax. So the model predicted that if corporate taxation is taken into account, an increase in gearing will have the following effect: that as the level of gearing increases, there is greater proportion of cheaper debt capital in the capital structure. So the firm, the cost of equity rises as gearing increases. We've seen that in the graph. We've seen that reflecting in the graph. So as gearing increases, the net effect of the greater proportion of cheaper debt and the higher cost of equity, that the WACC becomes lower. So increase in gearing results in a reduction in the WACC. So let's take note of this. Might jump a little. So you can see that now, that Modigliani and Miller therefore reach the conclusion that because of tax relief on interest, there is an optimum level of gearing that a company should be trying to achieve. So a company should be trying to make its gearing as high as possible to the maximum practicable level in order to maximize its value. So that gearing should be the watchword of most organization, because the logical conclusion is that companies should choose at least 99.9% gearing level. Why? Because it's cheap. There is tax shield on it. So a company should seek to be geared. Yes, should desire to be geared. So in simple terms, the summary is this for Modigliani-Miller proposition allowing for taxation. That Modigliani-Miller proposition allowing for taxation, the preposition one is that the WACC falls continually as the level of gearing increases. So in theory, the lowest cost of capital is where gearing is 100%. Yes, and the company is financed entirely by debt. That is Modigliani-Miller recognized. Modigliani-Miller recognized, however, that financial distress factors have an effect at high levels of gearing, increasing the cost of debt and the WACC. So for companies with identical annual profits and identical business risk characteristics, the total market value will be higher for companies with higher gearing. Yes, because people will want to invest in such organization because of the cheap cost of capital. So the cost of equity rises as the gearing increases. So there is a positive correlation between the cost of equity and gearing. So in summary, all we've been saying in relation to Miller and Modigliani with tax and without tax is seen on the screen. That value of a firm without tax is value of geared equal to what? Value of ungeared. With tax, it is value of geared is equal to value of ungeared plus what? Plus debt plus market value of debt. And when debt is introduced, the issue of corporate tax will be evident. So cost of equity without tax is cost of equity geared equal to cost of ungeared plus market value of debt divided by market value of equity multiplied by cost of equity geared and cost of equity, cost of debt. So that is without tax. And when tax is introduced, when you see debt, you see tax. So that WACC of geared is equal to WACC of ungeared without tax. But when tax is introduced, WACC of geared is equal to WACC of ungeared into the bracket of what? 1 minus dt plus d plus e divided by d plus e. So please, this is a summary of issues with tax and without tax. Now, you can talk of cost of specific capital. You can't talk about specific cost of capital without looking at CAPM. CAPM, what is CAPM? Capital Asset Pricing Model. Capital Asset Pricing Model. The Capital Asset Pricing Model, it's a topic on its own, but is also reflecting in the issue of cost of equity. CAPM is a concept used in portfolio theory as it relates to what? Investment in securities. Portfolio are collections of assets. So CAPM helps us to understand the issue of systematic risk and unsystematic risk. The issue of systematic risk and systematic risk. Now, when we talk about systematic risk, what do we refer to? I was joining the class on Wednesday partially, and I discovered the flow. So what is systematic risk? Yeah, somebody should help me very fast.
Systematic risks are those risks that cannot be diversified.
All right. There are those risks that cannot be diversified. So what of unsystematic risk now?
There are risks that can
It's
be
just the opposite. They are controllable risks. The risks that are particular to an industry.
All right, very fine. So systematic risk is also called a market risk, or what? Non-diversifiable risk. So it is a risk that affects the entire market or the economy. So no matter how diversified you diversify your investment, it will always reflect. To always reflect. Why unsystematic risk? It is called specific risk or diversifiable risk. So it is the risk that affects a specific industry or company. So you can reduce or eliminate it by diversifying your investment. So let's take note of that. So another approach to calculating the cost of equity in a company is to use the capital asset pricing model. So in capital asset pricing model, there are various things you have to know. There is the issue of security market line, and we have a formula for that, for this capital asset pricing model, where we talk about risk-free plus beta multiplied by what? Market return less risk-free. So the formula for capital asset pricing model is as seen above. So you can't determine your specific cost of capital without getting your cost of equity in relation to capital asset pricing model, because you need the beta factor. Yes, the beta factor you compute will be used in the CAPM. So we'll be seeing the steps to deal with questions on specific cost of capital. So in relation to CAPM, so this is the formula, as I mentioned, that cost of equity for company shares. For you to get the cost, you must know your risk-free rate of return, that this is the return that investors receive on risk-free investments, such as government bonds. And the market return is the average return on market investments as a whole, excluding risk-free investments. And we have the beta factor for the company's equity share. So we have this illustration here that the rate of return available for investors on government bond is 4%. The average return on market investment is 7%. The company's equity beta is 0.92. That's using the CAPM. The company's cost of equity will be what? Will be the risk-free rate is 4%. Government bonds are risk-free at 4%, and the beta is what? 0.92. The market return is 7%, and the risk-free rate is 4%. When you compute this, you're going to have the cost of equity to be 6.76%. So many notes, but let me just run through this. Otherwise, I'll jump very soon to. Well, everything is important anyway. So talking about business risks now. Why is it that some shares in companies are viewed as inherently more risky than shares in other companies. It is because the nature of their business is more risky as a result of potential fluctuations in profit or in the future are greater. So if things go well, shareholders may well receive much higher dividend, but the risk is that things may go badly, in which case they will receive much lower dividend. So the greater the potential fluctuations in return, the greater we say that the risk is. So the two types of business risk, we have the unsystematic risk and the systematic risk. The unsystematic risk is company-specific risk. Company-specific risk. So this is the risk due to factors within the particular company, such as poor labor relations or the appointments of new managing director. So the unsystematic risk or the systematic risk now, which is the market risk, this is the risk due to general economic factors, such as the level of inflation or changes in the exchange rate. That is the risk. Sorry, let me jump a little. Let me jump. Yes, let's look at this. The effect of gearing on beta. So looking at the issue of CAPM and MMM combined, that's when you're trying to solve for CAPM and trying to get the value of cost of capital in relation to Miller and Modigliani, that the published beta are for shares and therefore measure not just business risks of the company, but in addition, the effect of any gearing in the company. So we call this the share beta or the equity beta or the geared beta. So that there is a formula which is given to you in the examination. Yes, it's been long. I cited the past questions or the questions, but I think some formulas are always behind the questions. So now, in talking about beta, you want to get a beta in relation to a proxy company. In most questions, the debt factor of the proxy company will not be given. The debt factor of a proxy company will not be given. So working with this formula, it means that the other side of the formula will be zero. So when we're given a question and you need to solve for specific cost of capital, this formula will be reduced to just the first part because the debt of the proxy company might not be made available. So most times it's zero. So it means your asset beta will just be market value of equity divided by market value of equity plus market value of debt in relation to the tax shield. So, sorry, I want to be a little bit, yes, a little bit fast. Now, I just want to show these now. Steps to solve project-specific work. Steps to solve project-specific work. Please take note of this. Write it down as you are seeing it now. Steps to solve project-specific work. In a question, they will give you a similar company. For example, company A wants to diversify into another industry. Now, there will be a proxy company that is existing in that particular new industry company A wants to diversify into. So we need to get what we call the business risk in that industry. to get the business risk, then we factor in the business risk into the existing company of which is company A. Now, when you're given a question that involves specific WACC, the first thing to do is to identify the proxy company. We identify the proxy company. This proxy company, it's a similar company or a company that is existing in the new industry that you want to diversify into. Now, the existing company is the subject matter in this case. So once you identify the proxy company, you ungear the equity beta. You ungear the equity beta of the proxy company using the proxy company information. That is, you solve to get the business risk. So once you solve to get the business risk, you incorporate the business risk into the existing company. So once you ungear, then you regear. How do you regear? You put the debt element into the existing company. The debt element now. You put the debt element of the existing company. So once you determine the business risk here, using this formula, you regear to determine what? The equity beta. In determining the equity beta, it is asset beta multiplied by asset beta less debt beta multiplied by debt into the bracket of 1 minus t divided by what? The market value of equity. Now, most times I said, at this first instance, the debt value, the debt beta will not be given. So once it's 0, 0 multiplied by all this will be 0. So you just be left to work with this. So now, the point is, once you get the equity beta, you substitute the equity beta into the CAPM formula. So you use the equity beta to determine the cost of equity using the capital asset pricing model. So the cost of equity, to determine the cost of equity, it will be what? The risk-free plus what? The equity beta into the bracket of market return less risk-free. So when you get your cost of equity, you use the value of the cost of equity to estimate the WACC. The WACC formula is what? Cost of equity multiplied by market value of equity plus market value of equity plus market value of debt. In simple terms, that is the total market value here. So now, plus the cost of debt in relation to tax multiplied by what? The market value of debt divided by the total market value of the organization. Now, the proxy company is used at this point. Once you get the asset beta, you substitute the asset beta into the existing company to determine what? The equity beta of the existing company. So what you're doing is trying to bring in the business risk of the new industry you want to diversify into. You incorporate it into your own capital structure to see what will now be the effect to get the equity beta. So I made a presentation. Let me see if I'll see it. Yes. That the interrelationship between the steps the interrelationship between the steps that you start with the proxy beta. That is step one. You ungear it to isolate the business risk. Regear it using subject company's information and use the beta to get the cost of equity via CAPM. Then you combine the cost of equity and debt to calculate the WACC. So each step builds on the previous one. So we have a question. The question I forwarded to the class, to the WhatsApp platform the other time. So this is the question. Does somebody have solved and forward to me? Yes, and the person actually got it right. It's fine. Yes. And the question is, FIN produces hot air balloon. Its equity debt ratio is 5:2. The corporate debt, which is assumed to be risk-free, has a gross redemption yield of 11%. The beta value of the company's equity is 1.1. Sonny, are you raising up your hand? Please, you can put down your hand if you don't want to talk. So that's the beta value of the company's equity is 1.1. The average return on the stock market is 16%. The corporation tax rate is 30%. The company is considering a waterbed manufacturing project. Moyo is a waterbed manufacturing company. It has an equity beta of 1.59 and equity to debt ratio of 2:1. FIN maintains its existing capital structure after the implementation of the new project. What will be a suitable risk-adjusted cost of capital for FIN to use to apply in evaluating the proposed project? Now, what is the first step now? What are we supposed to do first? What are you supposed to look out for? The first.
Identify
The proxy company.
So the proxy company is what?
Moyo.
The proxy company is Moyo. Now, what is the information? What is the information you need from Moyo?
The beta of our assets. Beta of assets.
Asset beta.
Yes, the asset beta. You need to get the asset beta of Moyo to know the business risk. So how do you go about this? How do you go about this to get the asset beta?
You use ungeared formula.
So this is it. Write it in your book. Write it in your book. Yes. So now, from the question,
I got 1.2.
this is cowbell mathematics. All right, we're coming there. Yes, we'll meet you now. Yes. So now, we need to get the asset beta. How do we get the asset beta? We use this. Now, which information is given to you? Which known information is given to you about Moyo? Which known information is given to you about Moyo? Because the asset beta now is unknown. They should have just given it to us to avoid all this stress. But for exam purpose, they will always do it this way. Yes. So that you work for it. You work for it. So now, which information about Moyo is made known?
Only equity beta.
Equity beta.
We have the equity. We have
1.59.
the value of equity and the value of debt.
Okay, fine. Now, please, in your book, you know equity beta, right? So asset beta is equal to what? Equity beta will be what? 1.59. Isn't it? Now, the market value of equity is what? So, the value of equity.
No.
So,
57.
Is that?
so,
Two.
See it here. Debt ratio is given to you in terms of ratio, not in terms of big money now. You must always know the difference. In fact, there is an example or there is an assignment here that is very confusing, that people don't, most times, they don't know the difference between, where is this question? Yes, they don't know the difference between, for example, look at this word, that PPLC has a gearing ratio, debt to equity of 0.4. So most times, people don't know how to interpret these words. So it will be an assignment, though I gave an hint to the assignment, but we are not yet there. So now, you have the equity value of Moyo to be what? To be 2. To be 2. Now, in relation to the debt, it is what? It's 1. 1. Is there any tax?
30%.
30%.
30%, fine. So please substitute those values into this formula. Now, do we have debt beta? Do we have debt beta?
No.
0.
Is 0, fine. So here will be 0. Once this place is 0, 0 multiplied by all this is what?
0.
Is 0. So please substitute. And what will be the answer, please?
$1.17.
1.2%.
Okay.
1.18.
Okay. So it depends
So
on
you're
your
not
project.
solving it.
You said?
You're not writing it down.
No, I'm not writing it though. I'm supposed to be writing it. You're the one that you want me to write it. I don't want to write it. That is why if you see my expression on the platform, I say read. When I show you the steps, you're going to solve.
Like, I've been refreshing my device, thinking maybe I'm not seeing your screen. I didn't know that you have not been solving. Chinekele.
I've not been solving. You want me to solve?
So please, what is the debt?
Yes, please.
Hey, please solve. Most of us are on the road and we don't have access to calculator. We are just listening. Help us so that when we are going through it, it will be clearer.
Thank you, mommy.
That person that said that is not serious.
Please, what is that?
You know, one thing with these exams is that, you know, some people will just join the class. They are not active. That is why these exams, you must be intentional about it. That is just it. So you don't join my class and You have to pass. So I'll always push you to the point where you have to walk. So that is just it. So that is why I don't want to. The spirit is not leading me to write. That is why I don't want to write. Do it, write it. When you write it, you'll be fine, you'll be better. Yes. So that is the concept. That is why I don't want to. So
Uh, if I may get this, so asset beta is related to the proxy company.
yes. So what is, yes, it's related to the proxy company now. Now, but you need to ask yourself a question. What is this asset beta? Why are we using it now?
Because we
That
are trying
is,
to ungel the proxy company.
yes. So the asset beta is what itself?
It measures the business risk of the proxy company.
Yes. So the business risk now. So you want to know the business risk, the risk into the new industry that you want to venture in. So that is why you need to determine that, to know that. So once you determine that, you incorporate it into your own business to see what is the risk effect. What will be the effect of that risk to your own existing capital structure? So that is why we are trying to determine the asset beta of the proxy company. Yes.
Sir, how will you not measure the proxy business risks and the new business you want to venture into?
The new business
Based on this, using this asset beta now. For example, now we have for the proxy company, now we have the asset beta for 1 point something. Then when you inculcate it in the new business now, what are you arriving at? That is, you are still arriving at the business risks of the new company, or what?
Equity beta is what you want to get now of the existing company. You are getting the asset, the business risk, right? That is the asset beta. The asset beta will be incorporated into the what? Will be ungeared. Will be ungeared now.
Regeared.
Will be regeared rather. Yes, will be regeared into the existing business. So once you get your asset beta, the asset beta is what? Is without financial risk. Yes, the asset beta is business risk, just business. So for you to determine the financial effects now, you regear. And that is the next.
Okay. So now when you are regearing it, you are trying to find the financial risks now of the existing business.
Of the existing business.
So sir,
now,
for example, now, if you are given a question to start up a business and you're not given a proxy company, which of the because the one I've been seeing is the one that if you want to venture into a new business and then you're using a proxy company to be able to arrive at the new cost of capital. What if you're not given a proxy company and you want to venture into a new business? How are you going to measure it?
Definitely, you must sort for an existing business, an existing industry in that particular business you want to, except you want to be the innovator of that particular industry. Maybe it's an industry that has not been in existence, so you bear the risks on your own and try. Do you understand? You take the whole risk upon yourself. Since you are the first person that wants to innovate. But if it's a business that has been in operation, agriculture, manufacturing of vehicles, you need to know what is the risk the people in that particular industry are facing. Yes, the question will often give you that. So you must take note of that.
Okay.
So
Thank you.
please, what is the next thing to do? You know, I said you're going to put me through. So that is why I don't want to solve. So what will be the next thing now? We have to regear. Okay. So what is the result here?
1.1%.
So please take note. 0 multiplied by all this is 0. 0 multiplied by all this is 0. So this is insignificant. Take note, please. Take note. Let me put it in red. Yes.
Yeah, I got 1.552. Don't know what.
1.18.
So let's just let's just make it at 1 decimal point so that we'll all be on the same page.
1.2.
1.2. So the next thing to do is what? You regear, right?
Regear, yes.
You regear. So can you quickly solve for
Sorry,
this?
sir. Hello,
Yes.
sir. But the equity beta is in 2 decimal places.
I said some people are getting varied answer. Some people are telling me 1.7, 1 point this, 1 point that. So I said, let's make it to 1 decimal place. You understand? If you want to maintain 2 decimal place, fine. Yes. Me, when I solve it, I maintain 2 decimal places. Yes, I'm having 1.18. Yes. So I just want us to be consistent. So now the next step is to do what? Is to regear. Is to regear. So when you are regearing now, which information are you using? Is it the proxy company information or the existing company information?
The existing company.
Company information.
So very fast. Now, what we need from the proxy company is the asset beta. So we have it as 1.2, as we agreed, depending on what you want to use anyway. We've agreed that I want to use 1.2. So the asset beta is still what here? 1.2, right?
1.2.
1.2. So the debt beta is what? Any information about the debt beta?
No, sir.
Any information about the debt beta?
No, sir.
No information.
So this will be 0. So what is the debt value now?
2/5.
2/5. And the tax?
It's 30%.
0.3, right?
Yes, sir.
So please, when you simplify this, you have what?
1.5.
1.53. 1.54.
We want to maintain 1 decimal place.
1.5.
Let me ask a question. Why is equity beta greater than asset beta?
Because equity beta comprises of Business risk and financial risk.
Yes, that is just the simple answer. Because in equity beta, you have introduced debt. That is why it is greater than the asset beta. So what is the next step now?
I also want to ask a question, sir. Please, can you hear me?
Very well.
Okay.
For us to find the cost of equity using CAPM.
Can you hear me? The equity beta from the
Yes.
question, that 1.1,
Yeah.
was it just for confusion?
The equity beta?
Yes, the value of the beta of equity from the question, that 1.1.
Yes, it's just there for you to crack your head and ask, what will I use this for? Let's go back to the question. Yes, because in questions, there will always be certain information that are not relevant. So if you don't know what to do, you think you are not getting it. So in these exams, just follow the leading. Don't get confused by certain things. This thing is not there. This thing is, I've not used this thing. You just start canceling your work. So where is that value? That beta value of the company's equity is 1.1. So the average return on the stock market is 16%. Somebody is raising up his or her hand. Nina.
I'm still trying to. Sorry, sir. Good evening, sir. So I'm trying to understand how we got the 1.2 as the assets beta, sir. Hello?
Yes, I'm with you.
Because I've actually done all the calculation I could do, and I'm not getting 1.2. I'm actually getting 1.5. So I'm a bit confused here.
You're getting 1.5?
Yes, sir.
Wow, that is serious.
No,
So
I
how are
think
you punching the calculator?
So I've done it both ways. Like I did 1 minus 0.3, which is 0.7, multiplied by 1, which is 0.7 plus 2. It's still the same thing. Even if I do 2 plus 1 multiplied by 0.7, I will still be getting 2.1 divided by 2. It's still going to be giving me multiplied by 1.959. I'm still going to be getting 1.5. No matter the way I do it, I still get
Your
1.5.
dog is cracking, so I didn't.
no,
Okay,
you
sir.
can
I
see
said
1 multiplied by 1
now
minus 1
one
multiplied by
minus
3.
Sir, I said if I do 1 multiplied by 0.7, which is 1 minus 0.3, that's 0.7 plus 2. And then I do 2.
Multiply. Okay, plus 2, yes.
So
Yeah.
that's 2.07. So if I do 2 divided by 2.07, I'll be getting 0.96. Then I multiply 96. Then I multiply it by
It's 2.7,
1.590.
no, not 2.07.
0.7, not 2.07.
Oh, that's 2 plus 0. That's 0.7 now.
Plus 0.7.
Oh,
It will
okay,
give you
yes.
2.7.
You're omitting the one there. It's 2 plus 1.
I'm seeing the one. Okay, thank you, sir. I guess my problem was doing 0.7. Thank you, sir.
Yes, thank you. So it's one of the is one of the things you must guide against when you are in the hall. Yes, you must be very coordinated. Yes, and view view your workings well. Yes.
Please,
That's it.
you should guide me this second one. I don't know how we got 1.5. I think
So,
I don't know.
Even me, oh, I don't know how
I
they
think
got this 1.5.
Even me, oh.
so. I think there is a sign error there. After the 1.2 should be plus, not multiplication.
Okay.
So
Yes.
that's the thing.
Sorry, it's plus actually.
Thank you, sir.
Sir, can we be asked to find the cost of debt before we get all this, just in case if there is a case we're given something that requires us to get cost of debt.
Sorry, can you come again?
I say, is there a case that will be required to get our cost of debt so that we can incorporate it in our question? Is there a case like that?
Yes, very well. That is debt beta, right?
No, like yes, debt beta, yes.
Where you might need to use this. Very well. The question will make it clear. Yes. And by the time I send my slide, you'll see instances like that. Yes. Even this other question, yes, you should see instances like that. Yes, most of the questions, you see issues of debt beta. Debt beta.
So what's the formula for getting debt beta?
The formula for getting debt beta. The debt beta will be given to you as a figure in the question. And that is why you need to substitute into this point here. I don't know if this is what you're talking about or it's something else anyway.
That's it. But I'm saying, is there a case that they'll provide something for, okay, substitute? So I'm saying, is there a case they'll provide something that we need to get debt beta, or is it when they are silent about debt beta, we just put 0 as our debt beta?
Yes. Once they are silent about it, you put 0. But once it is clearly stated that the debt beta of the company is this, definitely you have to put it. Yes. But if there is no need for it, the formula will not capture it. But where it is not in existence, it's regarded as 0.
Gracia.
So the next thing to do is what?
We need to
Calculate our
use
cost of equity. Then CAPM.
cost of equity to determine cost of.
So we determine the cost of equity by using CAPM. So now the point is this. Okay, let's go on. Let's see. Let's ask my question. So to determine the cost of equity, we need to know our risk-free rate. We need to know our risk-free rate. So in the question, what is the risk-free rate?
11%.
Why is it 11?
The
Yeah,
one
got my
for the
with
already
5%.
existing company. Risk-free rate of debt. Is it not that one?
I got it
We are using the one for equity. Okay, should be for equity.
No, please.
Because
Is it
it
not?
was categorically stated.
Hello, sir.
Yes, I'm with you.
Is it not the one, the risk-free rate of debt that we'll be using?
Yes, it's the risk-free rate.
It's
Is the risk?
11%.
This
Okay.
one
It's 7.7. It's 7.7 now.
11. It's not the redemption rate is 11. The risk fee is not 11.
If you recognize tax, it's 7.7.
Okay, it's fine. I know what I'm asking.
Is 11%. It was categorically stated on the question, sir.
Now, please, this is it. You know, in the question, if you read the question, it is not stated that risk-free rate is this. It's not stated, which is assumed to be risk-free. That the corporate debt, which is assumed to be risk-free, has a redemption yield of 11%. So what is redemption yield? Mr. Olashile has been teaching you those things. What is it?
Value, it's not the market value. The redemption yield is a market value.
It's the rate now. Rate now.
The return expected by investors themselves.
Okay, now, so this is
the return on debt.
Okay, fine. This is the explanation now. The risk-free rate is theoretical return on an investment with zero risk. The risk-free rate is the theoretical return on an investment with zero risk. So typically represented by government securities or highly secured debt. In this question, the corporate debt is explicitly assumed to be risk-free, and its yield is what? 100%, 11% is taken as the risk-free rate. I put another write-up here that because Fin's corporate debt is assumed to be risk-free and the gross redemption yield is 11%, we treat that as the risk-free rate in the CAPM. So this is the common practice when corporate bonds are considered default-free, when corporate funds are considered risk-free. So in the question, take note, risk-free is not categorically stated. Yes, it's not stated that the risk-free rate is this. I was checking a solution and somebody used 5%. Yes, but after I evaluated the question, and I think this question is an ACCA question. Yes, yes. If you check it, it's an ACCA question. So once I checked it, I made further research on it, and I discovered the person that used 5 was wrong, because the person used 5 maybe based on the fact that 16% less 11%. I don't know. Well, the person didn't explain that. Just put 5. So the point is this, but after clear analysis of the question and checking the fact, it's seen that since the redemption yield is 11% and there is no risk-free rate in the question, so we use the redemption yield as the risk-free. Yeah, somebody solved it and sent it to me, and the person was correct. Yes, person was. I think the person should be in this class. Yes, and it's very fine. So the risk-free rate to use is 11%. To be used is 11%. So I asked the question so that you will take notes. You take notes that this is you don't just solve like that. So you have to look between the lines. So the risk-free rate, though most of you have been saying is 11%, it's 11. Yes, 11%.
So what they are saying, recognizing tax, this, what do you have to say? Some persons are saying it should be 7%.
The 7%.
7% where you recognize tax. I overheard it when I was saying 11.
Okay, somebody said
that one is
7, right?
Yeah, someone said 7.
Yes, we are coming to that point. But I think the person is actually flying ahead of us. Yes. The 7.7 or the 0.7 rather will be at the last end where we are trying to get the WACC, where we consider the tax effect. But in CAPM, we don't use that. Yes, it is when we're trying to get the WACC now that we're going to consider. You're going to see that reflecting the 7.7 reflective in the solution. Yes. So the risk-free rate is 11%. Now the equity beta is what?
1.1.
1.5.
And the market rate of return is what?
16.
16. And the risk-free rate is what?
18.5.
So once you break this down, the result will be what?
18.5.
18.5. So what next?
Getting the cost of debt.
WACC.
You solve to get the WACC. So what will be the value now? The cost of equity is what?
18.5.
18.5. The value of equity will be what?
2.
It's 5.
5.
5.
So overall, we have it as 5 plus 5 plus 2. So the cost of debt is what?
11 into brackets 1 minus tax.
The cost of debt is what?
Cost of debt is not given, but we assume to use risk-free rates.
Risk-free rate, which is what?
11%, but we are going to do post-tax.
Cost of debt. The post-tax value is what?
7.7.
So the value of debt here is 2. And we have 5. And we have 2. So please, you must take note of board mass. You don't just punch your calculator anyhow. You won't get the figures. So please punch this now. Let's see. Yes, Noble.
Okay, sir. Sir, why did you use 11% for cost of debt?
Yes, somebody should respond to that.
They said the cost of debt wasn't given. We have to use the risk-free rate, and we now recognize post-tax.
Notes. Okay. Somebody else should speak to that.
Okay. In the question, cost of debt was not given, but they told us that the corporate debt is assumed to be risk-free. So since our risk-free rate is 11%, so we assume our cost of debt is to be 11%. Then we have to do post-tax. That's why we have 7.7%.
So looking at the question, thank you very much, everyone. The corporate debt, which is assumed to be risk-free, has a gross redemption yield of what? Of 11%. Of 11%. So So now the cost of debt will be 11% because it is risk-free. So the yield of the debt will be 11%. Will be 11%. So this 11% will suffice as the cost of debt. That is why it is being used here as the cost of debt. As the cost of debt. So the result will be what for the WACC?
15.4.
So somebody else should confirm that.
15.4 is correct.
15.4%. Yes, Sonia.
Good evening, sir.
Good evening.
Yeah, concerning the step 3, how to get the equity beta, I'm getting 1.7 instead of 1.5. I don't know.
How are you pointing your calculator?
I calculated the first part, that is the 1.2 plus open bracket 1.2 minus 0. Then 2 times 0.7, that is 1 minus the 30% divided by 5. Then I added together. I got
Anytime you are solving
1.7.
anything that involve brackets, you solve the bracket first. So you solve this way. Now try and solve for this first. For this 1 minus 0.
I got 0.28.
When you solve for this, for all this, so 1.2 minus 0 is what? 1.2, right?
1.2.
When you multiply by what you have here, you have what? So because if you don't follow the pattern, you will just be pressing your calculator for 30 minutes and you'll be frustrated. Yes, it's
thank you, sir. I've gotten it.
all right. So please practice this again on your own, because even when you practice, you make mistake. You think this is not correct because you are not punching well. Yes, I remember somebody calling me a few hours to the exam, trying to get learning curve, log this, log that, and the person was frustrated. So please, if you don't have calculator, go and buy. Some people don't have calculator. Go and buy and practice with it. So please, I have questions there. I know most of you don't like solving assignments, but that is your own cup of tea. If you solve, it's fine. It will make you better and stronger. You're the one that wants to become ACA. So please, for your testimony to be complete, every assignment I've sent to this platform, I've forwarded on my slide. Try and solve them. And I will revert back. So the earlier, the better. I sent two assignments earlier this week on Monday morning, Monday evening. Today, I have quite a number of assignments, and you are expected to solve. If you solve, fine. If you don't solve, no issue. At least we'll do our part. So please, there are so many things in the notes that I didn't mention. So many things in the notes that I actually skipped. So please do well to go through them, and we'll become better. Yes. Mr. Francis.
Yeah. Good evening, sir.
Good evening, sir.
Yes, I just have a little question here, sir.
All right, sir.
Okay, would I be right to say the essence of we Hungarian, the proxy company, is to remove the debt beta, which is the debt element of it?
Of the proxy company?
Yes, that is the financial risks.
No, in the gearing company, they'll most times not give you the debt elements.
I mean, the proxy company, in the process
Yes.
of ungearing it, are we taking off the, will I say, financial risks now of the proxy company, which
Yes,
is
yes,
like
in
the
another
debt
way.
now?
Yes,
Yes,
in another way.
Yes, like the debt. So in the formula of calculating asset beta, I could see that we still write plus that debt factor that you said sometimes it will be given, sometimes will not be given, and we'll assume that it's zero. Why debt? Why try to incorporate debt again in the formula, since the process, the purpose of ungearing it is to take off the financial risks that is associated with the proxy company? I've seen a question that a debt ratio is given. So
Yes.
why still try to incorporate it in calculating the asset beta? That is my question, sir.
Okay.
Because I would have maybe be satisfied if we say that it is zero. We should just assume it's zero. It will not be given. In that case, we will know that we don't have anything to do with the debt element of the proxy company. We are just, taking the business risks, incorporating it in our company, taking cognizance of our own financial risks in the process of regearing it. So why do we still refer back to the debt element? That is my question, please.
Yes, going by the formula, the debt portion, the debt beta of the proxy company will be zero, always be zero. The debt beta of the proxy company will be zero. So now, once it's zero, it will be what? Equity beta in relation to the market value of equity of that proxy company, plus, that is the market value. Now we're talking about the debt proportion now of the equity of the proxy company, the debt proportion, the capital structure in terms of equity and debt. So the debt beta of the proxy company will often be zero. And if you look at most literature, that portion is not always there. But to explain why it is not there, we show it in the formula. So now, having agreed that the debt beta is zero now, you further said something that why are we reflecting debt in the main company? I don't know if that is the next point you raised.
Sir, what I raised,
Yes.
the main purpose of ungearing is to take off the financial risks of the proxy company so that we just make do with
of the business. Yes.
Of the business risks.
Yes.
So, and also in some questions,
yes,
it is right for us at that point to assume that the debt beta is zero. In that case,
yes,
we'll know that we are dealing with just the financial risks and the business risks.
yes,
So in some question, like the Pathfinder of November 2014, you will discover that the debt ratio of the proxy company was given, and we use that in getting the asset beta. Since the purpose of we ungearing is to just to get the,
business risk.
The business risk. Why are we making use of that debt ratio again? are we not still going back to where we are coming from?
No, we are not going back there. We are not. The debt ratio was used in which aspect of the formula?
It was used to calculate the asset beta.
The asset
it was
beta.
It was 0.4, and it was used throughout.
Even
like
the 0.4. The 0.4, is it the cost of debt?
No, it's the debt ratio.
The debt ratio, yes. You have to use that is the debt equity ratio. I think I have that question here. Let me see.
Sir,
something like that.
Sir, can I comment, please?
Yes.
Please, can I comment? Please, I guess Mr. Audu is confusing himself with debt beta and debt composition of capital structure. They are two different things.
I agree.
Madam, no. I'm not confusing myself. If you check the question, just go ahead. You see the debt equity ratio is there. The debt equity ratio is there, which is 40%. Then we have the debt ratio is still there.
Okay.
Beta, not
which is 0.4.
Which is 0.4.
All right. So no problem. Just I will check the question. Please message me on WhatsApp too. Let me view it likewise. Yes.
All right.
Just message me on WhatsApp. Let's take it further.
Please, what number is the question?
Number one.
Number one question, November 2014.
2014.
Okay.
Thank you.
Yes, Akorede.
Okay, sorry, I just want to make a comment on Mr. Audu's question. So, in a situation whereby you have to incorporate the debt better when you are doing your ungearing, you can always confirm with me that when you are regearing back, there will always be better of debt for the consigned company also, whereby you will also need to go and remove it again when you are trying to regear back to get your better of equity before you go and do your CAPM. If you check the question well, though I'm not referring to that 2024, but almost all the question I've seen that has better of debt for the proxy company, when you are regearing back to the for the company not consigned now, you will always have better of debt for that company also, whereby you also need to take it out.
All right. Yes. Well, thank you very much for your contributions. So please, Mr. Audu, you can still relate with me via the chats. Yes. So please, the assignments are there. Let's solve. So my Oga will give me further instructions if I'm to still come here to talk. Yes, I'm very much engaged. But once he calls on me, I'll create time to still come up. But for now, I think this is the assignment I've been asked to do. So he actually needs this so that he can take his own discussion further and take his own discussions further. So that is why he wants cost of capital to be treated as much. So thank you very much for your time. It's nice speaking with everyone. So let's have a pleasant night rest.
Thank you, sir.
Thank you so much.
Thank you so much, sir.
Thank you and good night.
God bless you.
Nice.
Thank you, sir. God bless you. Bye. Good night.
Thank you, sir. God bless you. Good night.
Please, sir, remember to share with us, sir.